Hello everyone! Approximately 1 month ago, I uploaded a video about in the topic Secrets of PE Ratio. According to me, it is one of the most very important video I ever made with almost 3 weeks of dedicated time on it. In that, we discussed about the rationale why I think there is a possibility that Nifty will go to about 20,000 in the near term. But I made it 16 minutes long, so I'm guessing that video didn't go well. Anyway, that's life. Still, if anyone wish to see that, I will attach the link in the description below and also on the cards. Please have a look. In that video, I mentioned the ratio called self-sustainable growth rate. Here, some might already know this and it may be completely new to some. Either way, I'm confident at the end of this video, we will be clear about the concept self-sustainable growth rate, rationale and the logic behind it. Now, according to me, and I will also show some evidence that companies with high self-sustainable growth rate over the current sales growth rate of the company often end up in multibaggers. Here, the sweet part is, as long as the company's declared financials are true, the risk-reward of investing in these companies is not greater than any other general famous stock. And also, there is a industry standard sustainable growth rate formula, which is one of the important question in CFA exam, and various investors tweak that formula to make it more robust and more suitable for them. So, after researching on various websites and others, I found such one robust modified formula which I use. All those we can discuss in this video, and I'm giving bit of warning, it will be full of numbers. So without delay, let's start. Self-sustainable growth rate SSGR is the rate of growth at which a company can grow themselves from their own profits rather than relying on additional sources like debt or bond or any form of equity dilution. Basically, it's a maximum rate at which the company can grow while limited to using its own internally generated revenue to fund that growth. For example, let's take Tesla. It's a startup that started in 2003 and Elon Musk becomes the largest shareholder in 2004. Here, between 2004 to 2020, Tesla depends on external borrowing for its day-to-day operations and activities. For example, in 2013, the total sales volume of Tesla was around just 22,000, but in 2020 it increased to over 5 lakh cars. Here the sales and production increased multifold, which is good for any company but was not managed by themselves rather than financed externally and mainly by the dilution of the company's equity share. And from 2020 onwards, the company stopped diluting the shares and stopped the borrowing. From that point, they can able to manage themselves. Here, most of us know what happens next to the Tesla shares after 2020. Basically, in otherwise, once it attains the self-sustainable growth, their stock skyrocketed. So, mainly for the startup, their self-sufficient growth rate is the intersection point where the mass general public, institutional investors started to believe in that company and started to invest in that company. That's the reason it's important to know that very clearly. Now the theoretical part. The theoretical formula to calculate a sustainable growth rate is return of equity times 1 minus dividend payout ratio. Now, in order to find the safe multibagger, we need to tweak those formula, and before that, we need to screen out or filter out the company in websites like screener.in by using or by following certain criteria. First, the company has to sell the products in the market at least for 5 to 6 years, preferably 10 years. Second, they have to make profit consistently, again in the last 3 to 4 years, preferably 10 years. Now, if you want to be ultra safe, like to filter out the financial cookbook companies, add the dividend payout ratio in the filter list. Since in most cases, the manipulative companies won't pay the dividend to the shareholders because they don't have money. After filtering all this, now assume we selected one company. Then once we select the company, we need to calculate or tabulate the following items for at least 5 to 6 financial years or for at least 5 to 6 financial quarters. 1. Net interest margin, 2. Dividend payout ratio, 3. Depreciation, and 4. Net fixed asset turnover. Here, net profit margin NPM highlights the ability of the company to generate profits from sale. Dividend payout ratio DPR indicates the share of profits that is distributed as dividends to the shareholders. Depreciation DEP indicates the wear and tear of a company's assets over the time. Like if the machine becomes older over the time, then it required to replace it. asset that required extra capital cost. To find that impact, knowing depreciation is important. Finally, net fixed assets turnover (NFAT) provides the sales generation ability of the company from their net fixed assets. If we combine all these four parameters in the following equation, then we will get self-sustainable growth rate (SSGR) of any company. Here, we all know that the net profit margin we can take directly from any stock market listed financials, but other parameters are not straightforward as it seems. For example, the dividend ratio that every company announce is the percentage of dividend in the face value of the share, and that's not the dividend payout ratio. I mean, some company provide straight away and most of the company not. For example, here Reliance didn't. So we have to calculate that by taking the total dividend amount as the percentage of total profit. Similarly, depreciation has to calculate as a percentage of net fixed assets. Finally, net fixed assets turnover to be calculated by sales for the particular year to the average of net fixed asset at the start and end of year. For all the companies, the net fixed asset will be directly available in the financials. Again, using this 4 parameter in the formula, we can calculate the SSGR, self-sustainable growth rate. Then, after calculating it, we can make it more potential by making it the average of 3 years for the given particular year. Now the $1 million question is how and when it will tell us that the stock will become multi-bagger. For that, it's 2 conditions. First, it has to satisfy this first condition that the self-sustainable growth rate has to be above the sales growth rate. Second, according to me, from 0 and at least for the next 2 years consistently, the SSGR has to be above 10, preferably at least for 1 year to be above 15. That's the inflection point where the company is going to take off or going to become multi-bagger. For example, these are the financial for the company called GM Breweries. So from 0 in 2012, between 2014 to 2015, the 3-year average SSGR becomes about 10 and also it's greater than sales growth. If we see the same time for the stock price, between 2015 to 2016, the stock price increased almost 10 times from just 50 rupees to over 500 rupees per share. Just a reminder, for calculation and explaining easy purpose, I took the yearly one, but it can happen anytime, I mean during the quarter also. So analyzing for the quarter is more correct way rather than doing it for the year. Here it's not just for this one share. I backtested multiple multi-baggers like Finolex Cables, Paushak Limited and Avanti Feeds etc. All follows the same phenomena. The reason behind that is it indicates that the company has the ability to generate cash in excess of the requirement to sustain its current growth rate. Such companies usually keep on accumulating cash, can afford to give high dividends without impacting the prospects of future growth, or can increase their growth rate in future without straining their capital structure like extra borrowing etc. Here just a bit of warning. This is what I believe and I use it for finding the multi-bagger safely, because as most of the channel viewers know me, I am a very conservative in investing. Different investors use different ways to find out the multi-bagger. I prefer to use this way to identify the odd man out. And also, even passing all this criteria, I will invest only if all other my generic checks pass on this particular firm. Means like the stock don't have to have debt and it should have sound management like Reliance, and it should have some form of moat or edge over the competitors like Jio, Google, Microsoft, etc. Mainly, I can able to put my trust in the management. For example, not in my wild of wildness dream, I trust Vedanta, so I won't invest in that at all. In conclusion, we can see that the companies which have high self-sustainable growth rate (SSGR) are able to grow in a debt-free manner and provide good wealth creation opportunities for shareholders. So that's all in this video. Hope you all found this video interesting and useful. Please consider subscribing the channel and liking the video, so it will help me beat the YouTube algorithm and also motivate me to do more. Please don't make any investigation based on this, as I'm not a SEBI registered advisor. I'm doing this for my and viewers educational purpose only. Thanks for watching.